Today, Bitcoin dips after another month of strong jobs growth. Athena Labs adds Bitcoin to the backing of its USDE synthetic dollar. And Fred Thiel of Marathon Digital breaks down how the Bitcoin miner is preparing for the halving. Welcome to CNBC's Crypto World. I'm Brandon Gomez. The crypto market moving lower after a fresh jobs report this morning showed the US labor market is still going strong. By noon Eastern, Bitcoin fell 0.2% and Ether fell 1.3%, just as the 10-year Treasury yield jumped thanks to that hotter than expected jobs number. Now, a stronger US labor market dashes some hope that the Fed will cut interest rates sooner than later, and that trickles down to bad news for the crypto market. Today's losses adding to the weekly declines for Bitcoin and Ether, which are down 2% and 4.8% respectively in the past 7 days. Okay, let's run through today's top stories. Athena Labs, the DeFi platform behind the Ethereum-focused USDE synthetic dollar, is adding Bitcoin to the asset's backing. Athena announced the move on Twitter yesterday and said taking on Bitcoin would allow USDE to scale significantly while also allowing the protocol to provide a safer product for its users. As a quick overview of USDE, it's pegged to the US dollar, but Athena Labs avoids calling it a stablecoin. Users deposit another stablecoin to receive USDE, and in the past, that initial deposit was sold for Ether. To protect against the volatility of Ether's price, Athena would also take a short position, betting against Ether's price at the same time. Now, Athena is adding Bitcoin to the types of assets it buys and shorts in order to maintain USDE's price. That short position also has the benefit of paying a yield back to the holders of USDE, which has led to the rapidly growing popularity of the asset. Athena's synthetic dollar launched at the beginning of this year and has already ballooned to $2 billion in value. Still, some have expressed concerns about the backing of the asset. Athena, though, insists the backing mechanism is very different than the likes of Terraform Labs' UST, which was algorithmically backed by Bitcoin. That project, of course, collapsed in 2022, leading to the upheaval of the crypto market. Next, Coinbase is officially the largest crypto exchange in Canada after securing a license in the country earlier this week. Coinbase says it's the first crypto exchange to be granted a restricted dealer registration by Canadian officials, meaning it meets the country's strict crypto guidelines and can legally operate inside Canada's borders. The expansion comes after a crackdown by the nation's regulator that pushed Binance out of the country, and as Coinbase faces a legal battle with the SEC here in the US. No real surprise here though, Coinbase has said repeatedly it would look to expand abroad as the US pushes on with its growing scrutiny of the crypto industry. All right, time now for our main story. Bitcoin miners have been hard at work preparing for the halving event that's taking place in just a few weeks. Crypto World's Talia Kaplan spoke with Fred Thiel, CEO of Marathon Digital Holdings, about how the mining operator is expanding its footprint ahead of the key technical event.
And speaking on CNBC last month, you discussed how Marathon is positioning itself for the upcoming halving. You pointed to your two recent acquisitions and noted that Marathon will keep acquiring. Just a few days ago, Marathon closed its previously announced acquisition of a 200-megawatt Bitcoin mining data center in Texas. Speaking on this show, the end of last year, you mentioned that you believe scale is very important. Can you take us through your acquisitions and how they can help your company get through the upcoming halving event?
Absolutely. So in December of last year, we owned only 3% of our operations, meaning the sites where we were hosted, because we had used an asset-light model to grow our capacity very quickly. We started doing acquisitions at the end of last year. We've now closed 2. Today, we now own and control 53% of our capacity. That's a pretty big jump in just a few number of months. Our total capacity now that we mine under is just over 1 gigawatt of power, and we own and operate just over 500 megawatts of power. So it gives you a feel for how quickly things can change when you set your mind to it. The benefit of owning and operating these sites is that it essentially lowers our cost to operate. It lowers our cost to mine Bitcoin because we're now taking out the middleman, if you would. The other thing that's been a very positive impact of this is we've been able to acquire these sites at lower than replacement cost, meaning a cost below what it would have cost us to build them in the first place. So this is a great way of kind of being able to expand quickly, leverage other people's capital. They build the sites, and then we come in when the market gets a little weaker for sites and acquire the sites. And it's been a very good strategy for us so far, but we'll continue to acquire sites, and our objective is to be predominantly owned and operated going forward in the future.
Other big miners like Riot expanded Bitcoin mining operations ahead of the halving, acquiring more than 31,000 mining machines. What other steps are you and other miners taking in preparation for the halving?
So most miners have been expanding capacity aggressively. As you mentioned in your comment, Riot has placed an order for a large number of machines. Marathon has as well. We have a large order as well as options on machines, which essentially eliminates the constraint on being able to acquire miners as we acquire more capacity. Based on the orders we have in place today and the options we have for additional machines, we could grow to about 70 exahash, which if you think about where we ended last year, which was about 28 exahash, a considerable jump in our capacity over the next 2 years. And we've publicly announced that we expect to be at about 50 exahash by the end of next year, but we may accelerate that depending on availability of capacity and growth options.
When speaking with CNBC, you mentioned that post-halving, you think the smaller miners will come under financial stress, which will cause the bigger miners to consolidate the industry. We spoke with CleanSpark's CEO recently, and he forecasted that 15 to 30% of miners will have to shut down following the halving. Do you think that's a realistic range?
I think if you look globally, potentially about 15% of the capacity may come under pressure. And by that, I mean that those operations may be unprofitable. And then it's a question of whether the miner wants to continue to mine, even though they're unprofitable, or if they just want to shut down operations. There are still a lot of machines that are of the older generations that aren't as energy efficient. Marathon is one of the most energy efficient fleets at about 24 joules per terahash. And as you look at other miners, the industry average is somewhere north of 30 joules per terahash. So the way to think about that is to essentially think that Marathon's fleet is anywhere from 25 to 30% more efficient than the global average. And so those miners that have machines that are above the global average in energy consumption will likely come under pressure. So we'll have to see, but I think most of the publicly traded miners are fairly well positioned at this point.
Is there anything you're doing right now to set you apart from your peers?
Well, one thing we do very differently than our peers is we really have 3 pillars in our business. Most of our peers just do pure Bitcoin mining at what we call utility scale, where you partner with a power company, you build a data center 50, 100, 200 megawatts, and then when the power utility needs the power, you curtail that energy and act as a load balancer for them on their grid. In the case of Marathon, we also have a part of our business which is energy harvesting. And this is where we work with parties that have excess methane flare gas, for example, an oil field, landfill methane gas, and also biomass from the manufacturing of things like ethanol and methanol. We can take that, turn that into energy, and then generate heat with our miners, which we feed back into a process. 50% of industrial energy is used for generating heat for manufacturing processes, heating buildings, etc. We believe that we can leverage Bitcoin mining to generate heat for those processes. And so we currently have a number of pilots in place today where we are deploying Bitcoin miners, whether it's on landfill gas, whether it's going to be flared gas from methane or biomass. And I think you'll see that part of our business grow. The important part of that business, though, other than the fact that we're mitigating methane, we're helping the environment, we're not using energy off the grid, so we're not taking energy off the grid. But more importantly, our cost of energy is subsidized by processing the biomass and selling the heat back, which means our cost to mine becomes much lower. And over time, and by that I mean over the next 4 to 5 years, our cost to mine will be below the industry average because we're not having to buy energy off the grid. We're not having to buy energy from utilities. We're able to generate our own energy. And that's a key thing. Lastly, our technology sector. We currently have developed our own firmware, our own pool for operating our miners. But most importantly, we've developed our own immersion technology. And at the Empower conference in Houston last week, we launched our 2-phase immersion, which essentially allows you to take miners and get a lot more production out of the same number of miners at an energy efficient rate, which is going to be really a groundbreaking event, I think, in the industry, allowing you to not have to buy as many miners to get the same amount of capacity.
All right, that wraps things up for us at Crypto World this week. We'll be back here again on Monday.